Welcome back, everyone, to Vox Markets Live. My name is Paul Hill, and I'm delighted again to be able to speak to equity analyst and stock markets commentator Paul Scott to discuss all things small cap. So welcome, Paul.
Thanks, Paul, and hello again, everyone.
Yeah, well, we've had another really busy week with all the corporate reports, trading updates over the past 7 days. Have you been buying or selling anything during that time?
Oh, do you know, I always forget to check, don't I? Actually, no, I've been on margin call for the whole of the last week, so I haven't been able to buy anything.
Yeah, no, it's actually pretty. The market has been going up, but it's still been quite heavy going, hasn't it? I mean, anybody who says it's easy to make money on the stock market, don't believe them. It definitely isn't the case.
It isn't the case. It's a constant struggle, Paul, isn't it? I find, I don't know about you, but I find, I know we shouldn't really care that much about day-to-day movements, but we do. We all look at our prices every day, and I seem to always have something that's pulling me backwards and drifting down, sort of offsetting the rises. But we had today, didn't we? FTSE Power well over 9,100. Quite a few things. I've actually just come off margin call today, so that's quite good.
Buy a few. Well, we've got also equally a couple of profit warnings of the day to cover later on. But before we do, I'd just like to say to everybody, we promised, me and Paul, we'd talk to a couple of companies this week, and we did so. We spoke to Grainger, the management team, for about an hour, which was really, really nice of them, on Tuesday afternoon, and then likewise with Eagle Eye on Wednesday. So let's start off with Grainger, who are the sort of the UK's largest private landlord of houses in the UK. They've got two types of property. They've got their old reversionary old houses, which they took on from the government, which they're selling from once the tenants have exited that particular agreement, and then they're investing it into build to rent, which are much smarter, newer properties that don't actually have any cladding, hardly any cladding issue, or zero, almost negligible cladding. Anyway, what was your take from our conversation?
Very, very interesting company. Definitely something I would consider for a long-term income type portfolio. I mean, the basic attraction of it, in really simple terms, of Grainger, is that it's got EPRA NAV of about £3 a share. And you can buy the shares for about £2.10. So you're getting it. I mean, that's true of lots of property companies at the moment. So you should, over time, see the discount to NAV narrow or reduce considerably. Plus, you're getting, I think, a 4 or 4.5% yield on it. And there's lots of interesting angles on upside on the particular properties as well, isn't there? It's quite complicated and multi-layered, but you know, if like myself, you own just a single buy-to-let property, which a lot of people do, I actually think selling it and buying Grainger shares would probably be a better option.
Well, I followed your advice because there's no chance I would want a second home, particularly a sort of holiday home, which I'm not letting out because I'd be absolutely battered on council tax. But with a tighter regulation on terms of renters' rights and now not having interest rates. So I'm with you. I wanted a bit of property exposure, so I bought Grainger. What I thought was quite interesting that he was saying, well, we should be able to get as a shareholder roughly a gross return after tax and pre-tax if you hold it in a SIP and an ISA of 8%, which is split 4% dividend yield and 4% capital growth. And that is assuming no narrowing of the discount, the 30% discount with net tangible assets over the next 5 years. And I would take that any day of the week. Low risk, low volatility, property-like returns, tax-free, held in a SIP and an ISA. I mean, what's not to like? Not in my view. That's why I own them.
Yeah, it's an unexciting investment, but I think it's one that people should do very well on, and the properties, I looked on their website as well. The properties are really nice. A lot of them, they're in major UK cities, most of them. And they're sort of like, a lot of them are like, I don't know what you call it, co-living spaces or something like that, where there's a communal areas, there's a gym, a residence gym, they get free Wi-Fi. They look really, I think they're self-contained flats rather than the studio type things, but they look very desirable. And funnily enough, one of their properties in Canterbury, I know very well. It's a warehouse conversion, literally around the corner from where I live in London. And so they seem to be quite flexible, the type of properties they own. But these sorts of properties are going to be permanently in huge, demand outstripping supply long term, I think. So I think Grainger's a really nice way to a hassle-free way to invest in UK residential property. Yeah.
Yeah. And also the guy who we were speaking to, the IR director, he said that he wasn't seeing any softness in rental prices, which was what, quite a few of the estate agents and the experts in the industries are seeing across the whole industry. But he said the demand was still pretty good. And yes, you would see, eventually, a slight reduction in elevated rental prices, but he reckoned it was going to normalize round about the wage increases, which was about 3.5% per annum.
Yeah, it was fascinating talking to him. Really, it was a masterclass, wasn't it? Him in how UK residential property works, And he said they got because of the dislocation of the pandemic and the lockdowns and all the rest of it, there was an artificially high increase in rents, and it's now reverting to the normal pattern where rents just mirror wages growth. So and the gearing is fine at Grainger. They've got fixed maturities, I think, on the debt, and it's quite substantial. It's about 1.5 billion market cap, isn't it? So I think it's very, very much worth considering, because just that niche of residential property, it's a nice way to get exposure to it. Whereas personally, I wouldn't want to particularly own REITs that own shopping centres or other properties that might require offices blocks that might require huge spending on them to meet environmental things, whatever. Grainger just seems a nice, clean business. So yeah, I was really impressed. Thanks for arranging the call, Paul. It was really interesting.
Well, it's not bad for somebody who's boring, is it, Paul?
Boring is good in the investment world. It's not a criticism. You're not boring anyway, Paul. You're effervescent.
Okay, right. Let's move to the other one. We spoke to Eagle Eye, who are sort of like a software developer for groceries, particularly for people like Tesco's and Asda and across the world, etc. Helps them with personalized promotions. So if you want to have a sort of like a crate of prosecco, as we talked about, or your curated beers, which comes from a discount from that particular grocer, then now the guys who do all the neat software to that, putting a layer of AI. What was your take on our conversation with Eagle Eye? Because obviously they lost that big contract in the States with their channel partner Neptune, who took the contract from them.
Yeah, I mean, I'm just very direct and sort of factual with my questioning, but I think I think I upset and offended the CEO a bit, because I didn't sugarcoat it. I just said, look, your profits have collapsed. You're not making any money now. So why is it going to recover? And he kind of bristled, didn't he?
Well, I only saw a bit of steam coming from his ears.
Yeah, but it was a good reminder to me that actually, when you talk to directors, they are passionate about their businesses, and they do take it personally, when the business underperforms. And I think he's very straightforward. We had the FD on the call again. They both impressed me with their straightforward answers to our questions, and they basically said we've got to accelerate the sales growth, but there are good reasons to think that that could be happening, particularly the partnership with was it SAP?
Yes,
they're going to do in the past they've direct sold, which obviously is time consuming and laborious. So opening up this partnership stream, but the bottom line is they've got to perform. They've got to actually get those profits back up, because at the moment it is only trading at PBT break even. So I think it's not a bad punt. I've always admired what Eagle Eye actually does, and yes, they've had a big bump in the road by losing one lucrative contract, but it's nothing to do with the product itself. It was that the customer bought another business that did this bit or something like that. It was a one-off reason, I think, wasn't it? So you bought the shares, haven't you, Paul? You like?
No, I've only got I have bought the shares. I've got about a third of position, third of the normal size position, which I want to add to when the liquidity improves. But I mean, just giving you the top level numbers, they trade at around about £2.30, which equates to about 1.3 times, 1.4 times sales, which, whereas for a software business is very reasonable. They've got a pretty good balance sheet. I think they'll beat the expectations on cash for this year. This coming year. It's from what the FD was sort of implying, that they didn't the cash burn will be less. I actually think if you've got a long-term time horizon, the CEO, Tim Mason, was pretty confident that he was going to almost double revenue over the next 5 years from sort of like 45, 46 to around about 100 and deliver 30% EBITDA margins. Now, if he gets anywhere near that, it's a minimum, in my view, of 3 to 5 times sales multiple, which you push that one through and you come to £10 to £16 per share. So I think there's masses of upside. And if they get it to work, then, as I say, I would not be surprised if SAP buys them, because they're effectively going to lift and shift their software and sell it to their grocers. And just give you an indication of the opportunity there once they're actually really starting motoring it. I mean, that is a big if, but once if they do still, they've got about 8 times more grocers on their books than actually Eagle Eye service currently. I mean, it's a massive addressable market. And if you think that Neptune, which was the US channel partner, effectively took their customer, just think what SAP could do when they add this onto their ERP system. That really is very, very sticky. So, overall, I as I said to Tim when I finished, at the right moment, I'll probably add to my position over the next sort of few months, on the basis that there won't be much happening news flow for the next 3. But I think by the end of the year, they should start signing some contracts with SAP. And once that happens, I think that's going to be the trigger for the share price.
Yeah, it could do. I think there's good potential upside on this if they can accelerate the sales growth. That's the issue, isn't it? I mean, it has disappointed, not just on that one-off contract, but they've been a little bit stuck in the mud because the standard sales approach is slow. It's 6 months plus just to integrate with the retailers' computer systems, but once they're in, it's very sticky. So I'm happy that the explanation they gave us, that this big high margin contract loss was a bit of a freak one-off type of situation. I think that I bought into that explanation from them. So I think it could be interesting.
Yeah. Okay, good. If anybody wants to ask Paul any questions, please put them into the chat box this time rather than the chat box. we've got three people asking about the profit warning of the day, which is Paul the Parrot. We've got Michael S. and Richard Leppington asking about Treatt, which is the natural flavors and fragrances business that largely serves people, basically drinks manufacturers, carbonated drinks, and also coffees and teas and stuff. They were hoping to have an uplift in the second half. That didn't come through. I own shares. I bought actually a second half of position about, 4 or 5 weeks ago on the assumption I thought the hot weather would actually help them out. Well, that doesn't seem to have occurred. Now, the big question of the day is it a value trap or is it a value play? What's your view, Paul?
I take a pretty dim view of this, actually. One of my team, Dave, he actually wrote a section on it, and he was quite forgiving on it. So he gave it amber green, which is our sort of 4 out of 5 star rating, which I thought was maybe a bit too generous, because I mean, this was a real big clanger. It was a big profit warning. They've revised down the current financial year. And back in May, they said everything was all right. Well, no, that's not quite right. I think they had a profit warning in, was it April? I think it was 10th of April, wasn't it?
Yeah.
Which wasn't too bad. And I think we both bought the dip actually on that. You and I both, because I was out in Gozo.
I bought before the dip, unfortunately, but you're right.
Oh dear, bad luck.
Yeah, I've been hit twice.
Yeah, no, I shouldn't gloat then, but I actually managed to catch a nice trade on this because I just banked the profit at about £2.60. I'm not actually tempted to buy back in today because I think this is a big miss. The profits are going to be half what they thought they were. So something's not right at Treatt. I think it's obviously suffering competitive pressures. Whatever it's doing isn't working. So I think management have got quite serious questions to ask here. But having said all that, you're now trading well below net tangible asset value. It's got a really strong balance sheet with well invested factories. They did all the capex over the last 2 or 3 years roughly. So you've basically got a brand new spangly new factory full of new equipment that was meant to power growth in margins and sales, and the opposite's happened. It's in decline. So I don't know what's going wrong at Treatt, but I think it's so cheap at £2 that it might be worth a punt, but I'm uneasy about it. So at the moment, I'm going to watch from a safe distance. So over to you, Paul.
Yeah, well, I'm going to hold. I'm not going to add. I mean, I only bought that second half position on the basis that I thought actually the hotter weather would actually help their P&L in that second half, and to not do well in a really sort of like, a very not buoyant, but you've got the other drinks manufacturers, you've got Coke and Pepsi and AJ Bar and Nichols all doing well, greater volumes, selling more fizzy drinks, and they're not actually seeing that come through in natural ingredients. Yes, you could argue there's a lag in terms of ordering for the summer season, and therefore they should have worked down a lot of that inventory, and therefore they should start seeing improvement for next year. But I think for me at the moment, it's a wait and see. I do absolutely get the asset backing, because I could see a private equity house effectively separating the industrial assets from the operating business, and essentially, sell off the asset base, which is, industrialized assets. You obviously got factories and a few warehouses and all that sort of stuff, to an infrastructure fund, and then run it as an operating business on top. So that is a possibility. It's probably remote, but it is possible. And I would say it's very, very cheap. But would I be jumping into it now if I didn't own it? No, I wouldn't. And I'm still, I'd say it's a 50-50 whether it is a value trap or a value play to me.
Yeah, that's fair. I think, it does say, quote, sales pipeline strengthened, but I think I feel this might sound brutal, but I don't really think management assurances have much value, given that they keep guiding the market incorrectly, because it's a big miss. H2 revenues, 66 million, previously 82 million guided. So this thing is being hammered by the competition, because I don't think the macro factors matter that much. Somebody's eating their lunch or drinking their Kool-Aid or whatever the phrase is, but you don't have to worry about debt. Low net debt position, it now says, for the September year end. So and it is still reasonably profitable business. So I wouldn't be surprised if somebody bids for it as well. Yeah. Because I know Lord Lee likes this share a lot. Well, I don't know if he still does, but in the past he's mentioned European, bigger global competitors are on sky-high valuations, and this would be a nice, cheap, tasty morsel for them. And it's got a very fragmented shareholder base. There are no blocking shareholdings. So if somebody came along and offered, say, £3 a share for it, I think people would probably sell, don't you?
Yeah, I would. but hey, longer term holders are probably bought at a lot higher, so it might be quite difficult for them to get over that one. Okay, let's move on to the second profit warning of the day. We've got Judges Scientific, down about 15%, was an absolute darling. Got a bit of a thump. Largely, it does basically scientific instrumentation, selling into the research and development areas. Unfortunately, they did actually flag back in March that they potentially could be seeing some of their sales at risk because of what's happening out in the States in terms of the reduction in funding for some of the labs and the research out there. That's what seems to have transpired, but it has caught the market offside still. What was your take on Judges this morning?
Well, one of my other colleagues, John, looked at this one in detail today. And his conclusion was, yes, it's obviously a profit warning. The shares dropped about 17% when he wrote this piece here. He's just said, look, it's not cheap, even after this drop, because the forecasts have come down something like between 24% and 27%. So really, the share price should have fallen by a similar sort of figure. it's, as you say, it's got an amazing track record. David Cicero hasn't put a foot wrong with all the self-funding acquisitions. It's really been probably the best buy and build on the UK market over the year. Massive multi-bagger, but I think it's now a bit too big to be doing. So the acquisition side of things now doesn't really move the dial much, and I think it really should derate. I don't find it even remotely attractive at the current valuation, I'm afraid. So sorry to sound negative on it. And there was talk of Chinese competition as well for some of the high margin. It's a very fragmented group. It doesn't it doesn't do synergies or strip out costs or whatever. Each business is autonomous, and a lot of them are mom and pop type businesses where the founder wants to retire. So it was a clever niche, but I wonder if it's maybe kind of got as far as it's going to go. So no, it doesn't appeal to me, and I don't think it really justifies a PE in the low 20s. Given that it's not performing very well. So are you more positive on it, Paul? Or?
Well, it still isn't cheap to me. I mean, if you're looking at 22 times PE, 3.5 times sales, I mean, yes, it might have a lot of IPR. I haven't done the hard yards. You'd have to basically do a sum of the parts on it and go through each individual business and value it at what it could be actual, sort of like worth in an open market or in a private transaction, a bit like Marlowe. And you suddenly find there's something in there, or a number of things in there are really worth a lot of money. But I haven't done that. But to me, it doesn't smell of really cheap.
No, it doesn't. And I agree. And you've also got to bear in mind that when they buy these businesses, they pick them up for peanuts. They're buying things on P's of 6 or 7 from the founders. By kind of schmoozing them and all the rest of it. So the package is then valued by the market in the low 20s. And it's almost the wrong way round, isn't it? For us, well, why would we want to pay considerably more than the sum of the parts? So the sheen has really come off this one, but it has disappointed it before and then subsequently recovered. And I think you also have to respect David Cicero a huge amount. He's got a great track record of absolutely telling it how it is. You can totally rely on everything in the commentary, I think. So it could come back, but 500 odd million market cap dropped now to about 400 million. I don't know what they're planning. Are they planning on doing more acquisitions? Do you know?
I guess they are. It's worked in the past, so I guess they probably are. Yeah, I wouldn't have thought they'd stop.
No, so maybe you could justify a takeover, because they've proven to be so good at takeovers. Maybe that justifies paying a bit more for it than we would normally. Maybe, yeah. Good.
We've got a quick question from Drew. He said whether you've been using your water cannon on the local pigeons or seagulls at all.
I've got to be a bit careful because I don't want to be done for animal cruelty or something.
Okay, but, RSPCA will be right.
Yeah, I did actually score a direct hit the other day. It was so satisfying. This gull literally attacking me, and I got it right between the eyes. So harmless water. So
okay, we got it. Okay, we got Rebecca. She's asking about GB Group, the ID theft protection business and location business. It came out. It was previously a darling about 10 years ago. And particularly during the lockdowns, bought an expensive business out in the States, probably overpaid at that particular point in time. It's now having to restructure that actual entity, which has slowed down some of its organic growth, but it is deleveraging. And it's not expensive now. I think I was just looking at the numbers. It's on around about 13 times PE. What was your view on GB's trading update? I think it was this week.
My colleague Dave wrote a section on this. We're moderately positive, which we call amber green, so 4 out of 5 star if you like. A lot of the readers of my Substack are interested in this and think it looks dirt cheap. So we were actually discussing it over the weekend as well in our weekend chat room. And I said to them, the problem you've got with GB Group is we're maybe all anchoring to the old valuation when it was a really exciting growth company and on a stratospheric rating. I mean, it's something like 50 or 100 bagged, didn't it? This was stunning share. But like a lot of massive multi-baggers, they come a lot of the way back down again, don't they? I mean, look at ASOS, another Boohoo, another glamour stocks. So if you actually look at these numbers, profits have been declining for about the last 3 years. So I would just question, is this actually a growth company now? Because it doesn't look like it. They're not, profits are coming down. So why would you rate it on a PE of more than 13? It's currently on about 13. Got a bit of debt, but as you rightly said, it is paying that down quite rapidly. I think on balance, we see the glass half full here. We think it's quite an interesting point. It's just approved a £25 million buyback. That's just started. And it's moving, I think, from AIM to the main market, isn't it?
Yeah, that's right.
It can cause some... It's not really clear at the moment whether that's a good move or a bad move, because, of course, it forces out all the IHT guys, doesn't it? Or it might force them out, depending on how strict their mandate is. Yield's only 1.9% on GB Group. I can't really get excited about it. I'm not convinced it's underpriced, but if it suddenly starts announcing that its growth is resuming, then I could see it re-rate. So I think it depends on the growth. I think you've previously liked this one, haven't you, Paul?
Yeah, I've owned it. I've made some money out of it a couple of times actually, but more recently, so I bought it in about I think it was round about sort of £2 about there, sort of like 2023. So I made a few bob, but I think the actual long-term growth rate at the moment is not going to be double digits. I think it's going to be mid-single digits. And if that's the basis, then I'm with you. I don't think it probably deserves around about a 15 times PE, but I don't see this a massive upside unless it's bought by somebody else. And I suspect it's worth a lot more, a sort of roll-up technology platform, or even a competitor who wants to take it out of the market and therefore increase prices. So I think it's worth a lot more to somebody else rather than actually to the market. And therefore, the path of least resistance in this M&A surge we've had over the last 2 years would suggest that actually it does fall into that camp as a potential target. But would they pay a premium? Probably not. They probably wouldn't pay a huge, knockout bid, but £3 could certainly be achievable.
That's a really good point. I hadn't thought about the takeover potential. I mean, again, American companies are on such high rate multiples compared with UK companies that it could be yet another of the many takeovers we've had where a US buyer cheerfully offers a 40% premium and it's still cheap to them. So that's a really good point. I hadn't thought about that. I might pick up a few of those just as a bit of a punt, actually. And fragmented shareholder base. Octopus is the largest shareholder with only 6.6%. Directors have negligible holdings, so they're hired hands. So it would be a fairly straightforward one for. Although I was talking to a guy in the city, and I'd be interested in your views on this, Paul. He said to me the takeover bidders prefer a company where they've got 2 or 3 major shareholdings. They only have to make a couple of calls to get a bid agreed. They actually prefer concentrated shareholder registers than fragmented ones. What's your view on that?
No, it makes total sense. The thing is are they professional institutional investors? If they are, then they'll have a rational conversation. Are they? But if it's all concentrated in the owner founder who's got the whole of his life wrapped up into it, you're going to get a blockout, a knockout bid requirement. But if you're just basically a Harwood Capital, or you're they'll be looking for a decent price for a decent company with a bit of extra, and therefore they can go out and recycle it. But if it's your baby that you've grown from the whole of your life, then price isn't everything; it's emotion, isn't it? And they also make sure the employees are okay and all that kind of stuff.
Yeah, because it's like with PhotoMe, the founder there, I think, owns about 38%, and they've announced that they've basically put themselves up for sale. So I would be astonished if for the reason you mentioned, I'll be astonished if it actually does get sold to anyone else, because it's his whole life, isn't it? So he'll want a knockout price. So interesting.
It's rarely you can get that. Okay, we got Grant. He's asking about your latest thoughts on big technologies. Is there light at the end of the tunnel? I think they came out with a trading update saying it got a bit of a foreign currency hit from dollars to the sterling as it was looking to do an acquisition. But I think the rest of the business was trading in line, having won that Northern Ireland custodial contract. These are the guys that do the electric tagging for prisoners in around the world. What was your sort of latest view? Didn't say much on the litigation, I don't think.
No, they didn't say anything on the litigation, did they? Although it was interesting that the broker, I forget which one, it might have been Pamuel's, one of the brokers covering it, kind of hinted that there might be a deal to be done on the litigation. I don't know where. They didn't back that up with any reasoning, but it certainly, reading between the lines, it sounded to me as if there could be progress on the litigation. Now that if that happens, that could be very good news. I wouldn't be surprised at all to see a positive outcome on the litigation, putting maybe 20% on the share price. So I'm actually turning more bullish on big technologies. I thought this update was good. I'm just scrolling down trying to find it. Here we are. It was on Tuesday. Didn't move the share price on the day. An H1 trading update. It said they'd resecured a Australian contract over 5 years, so that's good. Zeus left. That was it. It was Zeus who put a broker note out, very kindly available to us on Research Tree. That they didn't change their forecast, so it's only on a PE of about 13 times. Big Technologies is, and it's got over a third of its market cap in genuinely surplus net cash. And the other interesting thing was that the net cash actually rose slightly in the 6-month period, despite all the legal costs. So that I think was very reassuring. Although you don't know how much legal costs they've accrued and not yet paid, they could be running up a bill of millions. But I think this is quite good. Again, I'm tempted to have another. We did do a nice trade on this, didn't we, Paul? After the
we did. We made a bit of but I'm with you. If they can sort out that litigation, which is essentially the big elephant in the cupboard, then it's a no-brainer. It absolutely is worth a lot more than 93p. The issue you get with this litigation is one, timing and how publicly loud it's going to be in terms of disturbing customers and customer demand. Because if they start throwing mud again publicly and through the courts at one another, through the shareholders, Sarah Murray and the company, and also the old shareholders in Buddy UK with this whole litigation, it's a lot of money and gets a lot of headlines. Then hey, if you're going to be if you're a prison service around the world, are you really going to sign up to a team that frankly is not together and is not singing on the same hymn sheet, particularly when it's so mission critical? This technology has to get right. So I think,
although you have mentioned before, though, Paul, that they had a big clear out, didn't they? And the new management are not in any way tainted by the historical stuff. So I don't know. We'd have to. I mean, ideally, really, would be good to talk to one of their customers or prospective customers, couldn't it?
I don't think any of their existing customers are going to change where they currently use the service. It's just new customers. That's
large lumpy contracts. We know about the Colombia loss of contract. That's the other risk with this. But I mean, if they start with, with prisons full and the obvious benefits of finding alternatives and tagging people, you'd really need to do some proper digging into the product and how it compares with competitor. Because several of my readers have said, look, this is not groundbreaking technology. It's straightforward technology that's been around for decades. What have they got that can't be replicated by someone else? Probably not very much. Maybe they're a year or two ahead of competitors in some ways for product features. But I think that's an interesting point. I don't have a view on it, but I think that's the crux of what people need to research, isn't it, really?
Yeah, I think it's the clever bits, the software layer and the data that they've collected over such a long time to utilize that to basically give a better service. So the big get bigger, but you're right. I mean, you have to kick the tires. They've got great, blue chip. But anyway, I think I like it. I think the company's very cheap, and if they can solve the litigation without having to pay much, then I think it's a no-brainer. It's good, but the shares will react positively. So you have to get in ahead of it if you really want to make the most of it, I think.
Yeah, I think that's fair. I mean, I'm tempted to dip my toe in it with this again, I must admit. Are you still holding, Paul, or did you bail out?
No, I de-risked my portfolio after the Argentex wipeout.
Yeah.
which is actually just as we've got a question here just on on one of their competitors, Alpha, who have just been taken
Yeah.
out. And for me, that just rubs salt into the wounds. You've got a competitor who's absolutely buoyant, making money out hand over fist, and then you've had Diaceutics just went to zero. So it just shows you two bipolar results in the same industry, which is absolutely rocketing.
Yeah.
Okay.
Yeah. No, that was a bid from Corpay, wasn't it? Which we knew was on the cards. That was disclosed, I think, on the 2nd of May, and then it came through as a very generous bid yesterday, didn't it? I think it was, and the shares went up 25% on a, so it's a cracking deal. They've got it's obviously a fabulous business. Alpha is. I know my comments on it haven't aged well. I was saying that I thought it was overpriced and I couldn't understand the valuation. Bang, in comes a bid at about 80% higher. So I've looked a bit of a muppet on that. I think it's fair to say I don't understand that sector.
I don't think I do either. Right. Okay. Got a question from Michael Tuckman. He's asking about Diaceutics, which is basically a precision medicine life sciences firm. It helps pharmaceutical companies commercialize their new precision drugs. That sort of like maybe cancer or whatever like that, and they basically help them find labs to do the diagnostics for those patients, and also patients who they can then accelerate that whole commercialization process, which is a win for the drug companies, a win for the health authorities, because the right patients get the right treatments, less wastage, and also a win for the labs because they get more volume, and obviously a win for Diaceutics. They do compete against the other CRMs. Came out with a statement, I think, this week, and it was pretty much bang on, I believe. Any quick views?
No, I've drawn a bit of a blank on this. I don't think it's one I cover particularly, because the historical figures are very poor. It bumps along around break even most years and losses in the most but there are pretty punchy forecasts for it to roar into profits. So 100-odd million, 110 million market cap seems an awful lot for something that's kind of commercially unproven. So I didn't look at the update this week, I'm afraid. Yeah. So have you got anything else on it, Paul?
Well, other than that, really, I mean, it's trading at, to everything else, it's trading at a fair price for a fair company, and this still is. I think it's increasing ongoing revenue streams. It's like recurring revenue streams. It's got very good technology, and as I say, this needs to carry on doing what it's doing. It competes against the big CROs, so the likes of Covance, or I think it's called LabCorp now, and IQVIA and people like that. But in a tough, sort of like we've talked about the tough healthcare market, particularly out in the States, they seem to do pretty well, actually, growing very strongly. So yeah, I mean, Michael, I would say stick with it. I think it's a good company. If it ever came down in note, and it is illiquid, if it ever came down in note, then I would buy. But I have tried buying it before, and it's very tough to pick up any shares, actually.
Oh, okay. My spreadsheet's a bit slow. I was just trying to see if I've written about it before. If you've got a second, DXRX, isn't it?
Yeah, that's it. Yeah.
Yeah, here we are. Yeah, it's coming up now. Oh, I haven't looked at it since February. Low P. Oh no, sorry. I think it's gone wrong. No, sorry. Let's move on, Paul. I haven't really got. Yeah, sorry about that. I haven't really got Diaceutics.
Yeah, we've got Value Hound. He's asking about Wilmington, which is the regulatory services provider. It does sort of like services and data and stuff for safety and health and stuff like that around the world for providers, B2B services, etc. It's been hit, because I think it's quite into healthcare, been hit by a lot of disturbance out in the US with its hospital insurance. This has really been started off from Trump, because he started nailing all of the health insurers for overcharging Medicare and Medicaid out from the government systems, and therefore it's meant that the revenue stream for the hospitals has been tough, and likewise the insurers. If you look at all the big insurers, their share prices have gone down. Anyway, they came out with a statement that said that their organic growth was pretty flat year on year, which was a bit of a slowdown. They are cheap, but I guess the question now is it a value play or is it a value trap, particularly when we've got this sort of like movement to deregulation in healthcare, in banking, in oil and gas, and anything which is cyclically, challenged. What was your view on Wilmington?
We looked at this yesterday. There was a full year trading update for June 25 year end. It was in line, a slight beat, apparently, the adjusted PBT. So it's trading all right, 27.7 million against forecast of 27 million. So a little bit about, what's that, about 3% ahead of consensus. It's looking at doing more acquisitions. No clear guidance, though, given for the new financial year, and no broker notes available to us, the bane of our life. Balance sheet looks all right. It's got some net cash, 42 million net cash. It's about 15% of the market cap. Asset-light business model. We like it. Yeah, we think it's good value. So it's had quite a large pullback in the shares, hasn't it?
Yes.
Which could be, I don't know all the ins and outs of it, so sounds like it could be from the, I mean, it doesn't look that much on that graph, but if you shorten the time frame, it's actually, it's gone from £4 down to about £3, hasn't it? So
yes, it has,
yeah, that's it. So we think it looks attractive, actually, but we don't, I'm not going to predict how it's going to perform in the future because I don't really know it well enough, but excuse me, but I do think it's a good quality business. Yeah, very nice profit margins, great track record. So it could be a nice one to buy the dips. Yeah.
Yeah, I would say on valuation, have a look at the EBITDA ratio. It's about 8.5 times. Now, Marlowe got took out by Mighty at about 10.7 times. So it sort of fits. So what you're saying is that if it's in that sector that people are interested for M&A, no doubt about it. But if it was going to on the same price as Marlowe, which is in exactly the same industry, then you're probably looking at a 25% premium rather than 100% premium would be my take on it.
Yeah. Do we know the ownership structure of Wilmington? I haven't looked at that lately. Is it founder owned?
I don't know. I don't know. It's a good quality company with recurring revenue streams, no doubt about it.
Yeah, okay, good. We like it. We were just a bit. We thought it was a little bit too pricey. So now that it's dropped back quite a lot, that addresses that valuation concern. So yeah, I think obviously we never recommend, but I do think it to be a good one for people to do their own research on. Definitely.
Yeah, okay. Okay, we're going to go down the food chain a bit. We've got Clark Sean. He's asking about Inspiration Healthcare. It's only a £20 million market cap company. Came out with a AGM trading update, which was a bit more positive, but didn't really give much on actual figures. I don't know whether you had a look at this. I mean, I own it, but I don't know whether it basically does baby warmers and neonatal ventilators for the NHS and sells them around the world to go into basically the ICU units for very early premature babies.
Yeah, it was called something else years ago, wasn't it? And the original, they just, like a lot of healthcare device companies, they just found the inertia that they came up against at customers meant that it took absolutely years and years and years to persuade the clients and to get them to free up budget to buy them. Even if it's a good product. So I think they then made some acquisitions of other companies because the core business wasn't really going anywhere. So we got this reported today, didn't it? The AGM statement. Stronger performance has continued. Oh, that sounds all right. $6 million contract now fully delivered. And it's reduced its working capital needs. So that kind of implies that maybe, John's done some notes here. He said there's a lot tied up in working capital on the balance sheet. So the balance sheet would need a bit of scrutiny. Bit too much debt, £8 million net debt as at January 25, that was. And it's got leverage waivers in place from the bank, which I don't like one bit. So it does look like this is a bit financially distressed, which may not matter, but it could do. So we think it probably needs to repair the balance sheet with an equity raise at some stage. And we felt, John felt that there wasn't really enough upside to justify taking a punt on it. So we're amber red, so we're slightly negative because of the higher risk So, but presumably you like it, Paul, seeing as you hold it.
Well, I've held it for some time, so I'm underwater. I would say there's a 15% shareholder called Menon Medical, which is PE backed and in this space, that wants to get strategically into neonatal medical devices. So looking at the direction of travel, I'd be stunned particularly if the business continues to improve and win sales and de-gears, then I'd be stunned if they wait too long, because they'll end up paying a much higher price. So
oh yes, that rings a bell. I think you mentioned that a while back, that you thought it would attract a bid. Yeah, that could be a good angle on it. Yeah.
So I mean, I think you're right. The balance sheet definitely needs to improve. But let's see what the half year says in terms of where they are. If the brokers are correct, then it will be doing roughly around about it'll still be on around about 2.5 times EBITDA, net debt to EBITDA, which isn't great, to be honest.
No, that's a bit warm, isn't it? Definitely. Yeah.
Okay, good. We've got let me look at these questions. We've got a quick one. We've got Temperance Mysteries asking about Iomart, which is basically a data center business that's gone through trials and tribulations, and it kicked out its CEO in February, replaced with the exec chairman, who's got a bit of experience, bit of history in turning around IT companies in data centers, in the data center space. The debt to EBITDA is pretty extreme. I think it's roughly it's currently at about 2.7, but it's actually going to worsen next year, I think, or this coming year. So as the EBITDA comes down, so I don't know what your view on this one is. It's high risk, I would say.
I wouldn't go near it. I'm really negative on this. I looked at that this morning. Full year results came out March 25 this morning. Revenue is up, but EPS is down 2/3. And it missed. The shares were down 11% today, so it missed forecasts. It was about 25% below the forecast earnings. PBT was down 57%, so really pretty poor performance. But as you say, the problem is the balance sheet. Absolutely terrible. Net tangible asset value is -80. That's 80, -80 million. And it's got 84 million net debt. This is a 33 million market cap company. So what on earth they're doing there? They spent 57 million on an acquisition, fueled it with debt. I think they've, they're speeding 25 knots straight towards the iceberg, I think.
No, I mean, when they did this big acquisition, ATEC, about a year ago, they should have basically raised some money then, which was roughly around about £1.10. And they didn't. They went the whole hog with debt, and then the business started, not ATEC, the acquisition, but their existing business continue going south. I mean, to be very honest, the rule in this one is it was a value trap. I got caught in it, originally, because I thought it was a value play in the right sector, data centers and AI and all that kind of stuff, secular growth. But frankly, they didn't have the quality of the management team or the actual assets to execute on that. And then if is a value trap, or it's struggling, don't, as a management team, leverage yourself up, because you're just going to basically cut your own throat. I mean, which is what they did.
It does look reckless in the extreme. I think what it was. Done. So I wouldn't go near this one.
Okay, good. We got Drew. He's asking about Eleco, which reported this morning a trading update, which is my biggest position. But basically, a build tech software company that supplies a lot of the people like the house builders, but also the big contractors to be renovating buildings, building new sort of like not blocks of flats, sort of like offices and stuff like that. Their recurring revenue streams are going very well. The shares have actually done brilliantly in the last sort of like 4 or 5 weeks, but they sold off a bit here. However, I don't know if you had a look at this one at all.
Yeah, I knew this would come up today because this is one of your favorites. I was expecting to trot out my usual line on this, just saying, "Oh, it's a nice company, but it's too expensive." But actually, I think you can justify the current price. I've been slow to come to the party on this, but I mean, it's on I know you don't use PEs for valuing tech shares, but I do. I'm old school, and it's on a ShareScope is showing it as a PE of about 30, which does seem warm. But when you look at the individual broker notes and the growth, it's got very good ARR growth. And I think Cavendish put out a note today forecasting 7.9p earnings per share for next year. So that is calendar 2026, I think. So you're only actually on a PE of low 20s, aren't you? 21, 22 times, which I have to say, for a business that's got sticky clients, a very good ARR growth, I think you can actually justify that valuation. So I surprised myself when I looked at these numbers that I think actually it's a very good company, isn't it? Lovely organic. That's all organic, that growth, isn't it? Is that right?
No, there's an acquisition in there as well, but essentially the ARR is growing at double digits, which is the key, where the high margin stuff is. The construction industry has still got a few headwinds with higher interest rates and the disturbances about where people are going to site buildings and factories around the world and that kind of stuff. We've seen that through Breeden and other kind of infrastructure players. But overall, even in a tough market, if you can do double-digit organic growth, strong organic growth in your ARR and TR, basically total recurring revenue stream, which now is over 80%, then you're okay. The metric I would use, Paul, is either an EBITDA comparative or use a sales. And because it's 90% gross margins, I tend to use a comparative on sales, and the industry standard for the big boys, the big dogs, they're on around about 8 to 10 times sales. These are on about 3.5 times sales. And if you use it if you use it on an EBITDA multiple, I think the big dogs are on around about 25, 30, and these guys are on less than 15. So there's significant upside if you use those metrics. Because remember, in an acquisition by a private company or another company, you can strip out a lot of those costs, and that's why they tend to go from those type of multiples rather than looking at it as a straight PE. But hey, I'm happy. I saw the shares and drop off today, but it didn't surprise me. They've run up hard. It's a bit of a sell.
They've had a good run. Yeah, it's healthy. I think it's healthy to get little pullbacks.
And what I thought was encouraging is that it didn't fall that much actually, and then it got bid again. Because I think some institutions are looking to pick up positions. So this is a classic buy the dip and accumulate when there is liquidity for the institutions, I think.
Yeah, and it was in line, the outlook statement. I mean, the only thing we flagged, my colleague John wrote this, when you're on this type of punchy valuation, you have to at least meet.
Yes.
You really need to beat. But I would say generally on a results day, if it drops a few percentage points, doesn't matter in the slightest. I think it's only a concern if a share price drops more than 10% on results day. Then people have seen something's not right, or premium brokers have slipped out. Cautious notes, perhaps, that plankton like us don't get to see.
I know. You have to...
No, I do like it. Have you tried out the software, Paul, or spoken to any users of the software? Because I think that could be valuable.
It keeps winning awards in the UK for best software package, but in the build tech area, it wins it year after year. So
if anybody listening has actually uses Eleco software, leave a comment, get in touch with us, and tell us what you think of the actual software, because I think that sort of information can be absolutely invaluable.
Yeah, just to give you a background, it came out of a building contractor company originally, so like 15 years ago. Rather than just being a building contractor business, which they actually then eventually closed around about the great financial crisis, they then essentially concentrated on the software. So it's been built originally by people who used it. So it's actually it isn't done by a third party. It's done by industry guys. So that's probably why
you can't beat that, can you? Because they design the software to meet their specific needs. Yeah, definitely. I think it's still owner managed, isn't it, Eleco, as well? Is that right?
No, it isn't. No. There's some big shareholders. There's John Ketley and his brother own together about 20%, but the biggest one is Herb Allen, who's a PR. He's basically a big media mogul out in the States. I think he's about 20. Oh, really? He's the guy who will. If anybody wants to approach the company about buying them, they'll knock on his door first.
Yeah, but I think
I'm guessing.
management having 20% is fabulous. I
Yeah.
love owner managed businesses. I think I've never actually measured the numbers. I don't know if you have, Paul, but I'm anecdotally I'm convinced that owner managed businesses long term perform better than hired hands who are chasing their share options and doing deals to empire builds, you know?
Yeah. Yeah, they're not managers now. John Ketley and his brother had left the business about 3 years ago. So,
Oh, I
so
see. They're retired,
there's a different
are they? Yeah.
manager. There's a different management team. Okay, good. We've got another question. Rising Bull 1985 is asking about moneysupermarket.com, MONY, MONY, which basically
Yeah.
came out with a statement or some numbers just recently. It's a bit of a mixed bag. It's seen an improvement in energy, which used to be a deadbeat, but I think car insurance, the price comparison websites side of it, was struggling a little. The key question for me in all these is how impacted it's going to be by generative AI and Google search changes. But anyway, what was your take on moneysupermarket.com?
Oh, it's not coming up on my search thing. Oh, 21st of July. I must have forgotten to put the tickers in. I think I'm going to have to talk while I'm searching for it. I think it was, what did I say? 21st of July, was it? Is that right?
Yeah, I think it was on. It was in line. Yeah, it was in line. The shares fell by about 5%, I think.
Yeah, this is the one where there was stagnant growth, wasn't there? There was very little growth in evidence. I think it's not. Yeah, I found it. Sorry about that. Yeah, it dropped 7% to £2.5. Do you know what they are at the moment? This was on Monday.
Yeah, £2.8, £2.9.
Oh, okay, so it's barely changed. Yeah. Earnings per share, this was H1 results, was up 4%. So pretty anemic, really, profit growth there. And outlook was in line, confident within the market range. Oh, yes, it's coming back to me now. They said EBITDA, the range is between 137 and 150 million EBITDA, which I really like. I love it when companies say, look, it could be between this. Here's the range of possibilities. That makes so much more sense than giving it a specific exact number, doesn't it?
Yeah.
It's balance sheet's not great, slightly negative, but it doesn't matter because it doesn't have inventories or fixed assets to speak of. This is it. The main standout feature with MONY is the divvies. You get a 6% dividend yield and you're on a PE of 12.3. We thought, look, price comparison website, competitive sector, not likely to ever be on a premium valuation, any of them, I would imagine. So probably priced about right. But I think for income seekers, I can understand why you would like that. So over to you, Paul.
I think my biggest problem, I think, with the whole price comparison websites is basically future growth with generative AI. I mean, I just look at how much time now I spend on ChatGPT, on Gemini, approximately sort of like, around about half of the time. I mean, I'm hardly ever doing a search now because it's a pain in the proverbial to do it, because it's much easier to get an answer. And so I get an answer, and that has two negative effects on the price comparison websites. One, it reduces the traffic, the click-throughs coming through, because it's not knocking on the blue links. So you have to basically rely totally on your own first-party data, people returning rather than new people. And I bet you there's at least a third of the traffic that goes to these price websites which come through from the usually from the search. And also the other side of the coin is it just wait until ChatGPT and Gemini start giving you the answer when you say what is the cheapest package, and then they want to basically monetize it. So they actually do their first part of the party data rather than, so they take both of that away from you because they need to replace their search. I could be just putting it into a doom loop, which is totally wrong. But I just look at what I would want myself. It would save me a shed load of time if I could just rely on ChatGPT or Gemini to give me what I want in one shot, and then that's what I'll do. But there is a trust rather than having to spend half an hour and 3 hours deciding on what power contract I'm going to go for, what insurance I am for this year, car insurance, But much easier and quicker, and should be cheaper. But that'd be my take on it.
I think that's a really good point. I mean, as you know, I've played around with ChatGPT a bit, but I've not sort of really gone into it in any great depth. And I need to, I clearly need to do more work on this. But those are very good points. Did you see the article in the Guardian today? My colleague,
No.
yeah, there's a very interesting article in today's Guardian. I think it was today's, that Alan, one of my team, he sent me a link to it, saying that apparently Chat GPT searches are now causing a 74% drop in web traffic to companies that relied on the blue links. So I think you're really onto something with this. Yeah, we were discussing it, me and some other friends, investor friends. I said, well, is this why Future PLC, FUTR, is on such a crazily low PE? But this another friend, Mark, he reckoned that Future doesn't, because people subscribe for its specific publications, they're not going to it through search links, but he thought it might restrict their ability to recruit new customers, so it does feel like big changes are afoot, doesn't it? So I think I think you're absolutely right you've been focused on this area for a while. You mention it nearly every week, actually, and I think
I only use myself as an anecdotal user, and it's great. I love it. I think it's the amount of extra save. It just saves me a huge amount of time. Okay, we've got Amanda just switching sectors. She's going for the profit upgrade of the day. Pebble Beach Systems, small company. We hardly ever talk. Only 11 million market cap, up 45%. It basically does neat software and systems that go into broadcasters to help them plan there and run and all of their programs, largely I think over the web. It was actually spun out of Vislink years and years ago. It's had quite a lot of debt from Vislink, unfortunately, but it's now taken it down, and it surprisingly, it really does seem to be now gaining traction, and they had basically better sales today, which is a tough sector in publications and media. What was your take on it? It certainly sort of surprised me.
It surprised me as well. Yeah. I remember this now. Now you mentioned it, it's coming back to me. This was the specialist cameras business, Vislink, which was absolutely run into the ground by poor
John
management.
Hawkins.
He did a terrible job. And they, as evidenced by the numbers, that's not my opinion. And he bought Pebble Beach as a sort of life raft, I think. And it was, and then I think the old Vislink business, it even went bust or was sold off for next to nothing.
Sold, for nothing.
Yeah, and it was a great value share. It looked really, really low PE and blah, blah, blah. But I think the technology just moved on. But anyway, so Pebble Beach was kind of left with the listing and was far too small to be listed, had, as you say, far too much debt. And it's really looked very wobbly over the last few years. But I have to say, I read the announcement today and I think it's absolutely transformative. I really do. They said the H1 trade, we're just cold analytical minds. We're not emotional about shares. When the facts change, you change your mind, don't you? And anyway, materially ahead of market guidance, it says. H1 be a £2 million EBITDA against 1.4 last year. You've got to take off some costs from that to get to real profit. They've done £2 million per annum cost cutting. So two things seem to have happened at Pebble Beach. They're gaining some traction with contract wins and order intake, which is strongly up, giving good visibility, and they've slashed their costs as well. So that's just the perfect combination, I think. So this is dramatically improved today. So big congratulations to shareholders. A friend of mine, Simon, has been banging on about this for years. He's said, it's got really good potential. So I'm thrilled for him and for other shareholders that it's come good today. The balance sheet's still weak, but it's reduced the net debt a lot, down to 3.3 million, which is no longer a problem, I would suggest. And it said today it expects to clear that debt in full in 2026. So fantastic result. Yeah. I mean, it is valued now at about 16, 17 million, which, is probably up with events. But, and do remember as well, just to temper my enthusiasm a bit, I checked my notes and it did warn on profits on 14th of January this year. So today's ahead of expectations is kind of putting it back to where it originally was before the profit warning. So, do bear that in mind. But yeah, delighted for holders of it. It's really good. Does it float your boat, Paul?
Well, I couldn't get any liquidity in it. I mean, if you actually look at the chart here, there's lots of sort of flat lines, which says to me there just isn't sufficient volume. If you wanted to get 5 or 10 grand's worth, you'd probably no problem. But for me, it's probably just too small. I would say if I was going to kick the tires on it, have a look at the competition. I'm stunned such a small company can do so well in a market that's full of giants for media. Sort of like play out services. And managing programs and schedules over the internet, particularly when everybody's lot of people are doing a DIY and there's YouTube and all this sort of stuff. But they must have something to get that growth, because I thought it would be a tough market, but I got that wrong.
Yeah, that's a really good point. They must have something, mustn't they? I think there's another tiny little video software company called Blackbird, which apparently has got the most amazing products, but it never gets anywhere. It just makes losses every year, tiny revenues. So it's all the more impressive, I think, that Pebble Beach does whatever it's doing and whatever product it's got is obviously gaining some traction, isn't it? So lovely to see small companies succeed, because so many of them fail. So
Good. We've got Jim. He's asking about MP Evans, which I think is basically the it's palm oil. It's what was it called? It's an all natural palm. Yeah, it's basically Amazon friendly palm oil growers out in Indonesia. Shares have done very well as the palm oil price has improved. I just wonder any views on this and how you value it, because it's a soft commodity business that I know Indonesia. I don't think it gets too many sort of hurricanes or cyclones out there, but it does get earthquakes. And if you're a soft commodity, then unfortunately, if your plantations get ever caught in it or you have a fire, then you get absolutely walloped. So I just wondered, just treating more broadly, sort of like, soft commodities, how you view them, and likewise with palm oil with MP Evans.
Well, it's not a sector I invest in, because, the trouble is you're completely at the mercy of whatever, as you say, the commodity prices do, and yet you've got largely fixed costs. So that's the kind of opposite type of business model that you and I typically go for, where we want stable, predictable companies with pricing power, where you can predict. But I mean, looking at the headline numbers here, PE is about 10 times. Dividend yield 3.7 times, strongly asset backed, negligible debt, I think. I can't remember. I think did it announce today or yesterday? I know we didn't cover it. What's the ticker, Paul? MPE, is it?
MPE, yeah. No, it did announce about its palm oil production, which I think was in line with last year, and prices were slightly up, I think, and they were just higher than expectations. So it keeps driving the share price higher.
Yeah, no, that's why I didn't cover it, I think, because it was just a sort of production update thing. And we've covered 28 companies today in my report. It was ridiculous. Yeah. And we had to miss off the 10 largest ones because there were 38 companies. But anyway, we covered MP Evans in March and in June. And both times, me and the team were amber green on it, which is our 4 out of 5 star rating. Yeah, so we like it on the basis that you've got a good dividend yield, good value and decent divvies and a decent balance sheet as well. It's got net cash as well as strong net tangible asset value. So that's unusual, isn't it? So we quite like it. But I suppose readers have got to assess for themselves how much that's been factored into the rising share price. It could be up with events now. Would you really want to pay much more than a PE of 10 for a plantation?
Yeah, no, I know. And what's the reuse value of the plantation? Probably zero, unless are you really going to put houses on it? I don't know, on the side of a mountain.
Yeah, and also, when you have hurricanes, they show the videos on the news, don't they? The palm trees always seem to be able to take it in their stride, don't they? You see the branches frantically flapping about. So maybe I can't see how an earthquake would uproot palm trees. So I don't know. Maybe they're more resilient than we think.
Yeah, no, could be. Just don't get the bugs there. The last thing you want is a sort of like a disease palm tree, sort of like virus.
Yeah, true. And there's some sort of issue with environmental issues with palm oil, isn't
yes.
there? I don't know what
sustainable. I think all theirs are sustainable, which means
Right.
they don't knock down the Amazon rainforest. I think is probably.
Oh, that's good to know. Yeah.
I think that's one. Okay, we've got who was it basically? Oh yeah, Martin. He's basically asking about Coates, which is the industrial thread needle. It's not thread needle, the industrial threads business that goes into sort of like performance shoes, and it goes into apparel, hard wearing and stuff like that. It made a massive acquisition about a month ago and a few weeks ago, did a really big fundraise, about £250 million equity placing for a $770 million business. I don't know whether you've ever looked at this. The shares went down, obviously, on the placing, as you would normally expect. But it's now turned into a pretty big business. Market cap 1.5 million, trades at about 10.5 times PE. Market's a bit skeptical. I think the business it bought was a sort of performance insole business to go with its threads business in sort of performance shoes. Not far off, actually, a similar model as Zote Foams. You know,
I was just thinking of Zote Foams. Yeah.
But I don't.
So yes, I was just going to say the readers, the listeners today are really catching me out because they keep mentioning stocks I haven't looked at.
Oh, okay.
But anyway, yeah, I haven't looked at the latest update from Coates, but I did look at it in near the end of May when it put out a trading update that was mostly in line, I think. We do have concerns about the debts, though. It's got quite a lot of net debt. It's not a business I know very well, but certainly the balance sheet at December 2024 doesn't pass my testing. It's negative, quite strongly negative net tangible asset value. So I would, I haven't really got any particular insights on Coates. I was just amber on it, which is neutral. But I would flag to people that you need to look at that balance sheet quite carefully, particularly if it's done this latest acquisition. If they funded some of that with equity and some of it with debt, then the debt position could get worse. I don't know. So that, I think, is the area to focus on. I mean, it doesn't sound a very sort of exciting area, does it? Is it? It doesn't strike me as the sort of thing you'd like, Paul.
Well, it's interesting. It isn't something I'd typically go for, but would you expect that business to deliver 20% EBIT margins?
No, I wouldn't.
Exactly.
Yeah, but hang on a minute. Depreciation, it's going to be capex heavy. So what's the depreciation charge?
No. EBIT margins 20%.
Oh, EBIT. Sorry, I thought you said
depreciation.
Oh, okay. Yeah, fair. Yeah, because EBIT's the same as operating profit, isn't it? Sorry, I misheard you, Paul. Well, no, that is impressive. 20% operating margin is a quality business, isn't it?
It says it's got a good pricing power to me.
Yeah, it does. Yeah, you're right. Well, you see, my preconception looks to have been wrong. PE of 11.6 I've got on ShareScope, 3% dividend yield. Negative. The balance sheets. The issue, it's a negative balance sheet. So balance sheet and debt is the area for people to research, I would suggest. But potentially interesting.
Okay, good. We've got a final one from Vicky. She's asking about hVivo, which I think came out with a trading update this week. It was basically all in line, wasn't it? I think. But what was your take on it? Slightly better, actually, I think, at the EBITDA level.
Slightly better, yeah. Can you talk for a second, Paul, while I call up my notes?
Yeah, I mean, basically for the audience, I mean, hVivo is it does these challenge trials in its facility down in London that takes sort of like students and test new vaccines and new antivirals on the students to see their reaction and to accelerate that whole drug discovery basis, largely in phase 1, phase 2, and phase 3. It's got lumpy contracts because these things are high value, and it came out with a profit warning largely because of what's been happening out in the States with Trump, that's been knocking a lot of the drug development and R&D for the big pharma and reducing their budgets. So they've taken down revised guidance, but I think they held their guidance, and in fact, I think they took it up very slightly. But what was your sort of latest view on it?
Yeah, I found my notes on this. We follow hVivo very closely. It's a very popular stock amongst private investors. And I'm sorry to say, we did get this wrong. We were positive on it, amber green, which moderately positive. When it got down to about 20p, it peaked at about 30p, and we were saying, look, it's too expensive at that sort of level. But when it got down to about 20p, earlier this year, we said, look, we think it's good value now. So I'm sorry we got that wrong, because it's actually halved since then. But, you know, we didn't know what the large lumpy orders were going to go wrong. I do think it's value now, I must admit. As you say, the update this week was a more kind of reassuring one. It was an H1 trading update. It's actually loss-making at the moment, though, which is not good. And they seem to have cranked up their overheads, and I think made an acquisition with hindsight, with really bad timing. Yeah, so it was more sort of things aren't getting any worse. They're actually not quite as bad as we thought they were going to be type of update. So I like it, actually. I think at around 10p, I could be persuaded to have a little flutter on hVivo, because you've got a lovely, strong balance sheet with plenty of cash, gets paid up front by customers, but it's got own cash as well. And substantial pipeline of opportunities. Well, you know, companies always say that, don't they? So I think at 10p, I mean, if all I would say is if it dropped back down to a low point of about, I think the low point on the profit warning, because it was a really bad profit warning, this one, really bad. And it just went into free fall down to about 7p. And I remember it was, I was in Alderney on holiday, and I couldn't decide whether to push the button and buy some at 7p. So I did what I always do when I'm confused, and I went back to bed. And by the time I woke up, it had bounced to 10p. So unfortunately, I missed that trade. But I think, I think if it carries on drifting back down again, and it's got that look about it at the moment, you know, I think it might drift back down to about, if it went down to about 8p, I'd nip in with a little trade on that, I think.
It's quite interesting, actually, because we look at it in two different ways. You look at it on, you know, the price you pay in terms of the existing business, whereas the trigger I would do was that the industry at the moment is artificially on hold. It's halted development. That's backing up a shed load of R&D on on new drugs. The trigger I would use, as soon as I'm getting more comfortable, actually, the US biotech boys are starting to release budgets in new drugs and want to put them through trials and this sort of stuff, which will change, because it's only been artificially held back because of all the shenanigans going on with regulation. Once I get comfortable on that, then this will do really well. So I wouldn't be bothered about. I would buy it higher if I saw effectively the industry improving. Not that it's a surefire way, but it's just quite interesting difference in how we view it, because I just want to wait until that sort of like air pocket in demand sort of like finishes.
That's an absolutely brilliant point. I mean, you're right. I'm focusing far too much on short-term valuation, and that is, I mean, in an ideal world, we'd look at both, wouldn't we? So I think what you just said, what I just said, the ideal combination is to combine those. You know, I'm just thinking in value terms. I want to buy. I am a value investor at heart, and that often sucks me into rubbish companies, unfortunately.
Join the club, Paul. I've been there many a time.
So you do have to be careful with value investing, but I think if you can cross over those two things, you can get it at a lovely price, and there are good reasons to, you know, profit warnings. You want profit warnings that are short-term fixable things, and you could well be right. This could be just an industry dislocation that could pass in time. So yeah, I think we're going to have to get some of these, Paul. Do you hold any at the moment?
No, I don't. As I say, I'm just waiting till I get more comfortable on the industry and the wider. And they've got the balance sheet, they've got the existing contracts. They're not going anywhere. They're ready for it when you get an upturn. To me, this is not dissimilar to any other industry that just goes through a temporary air pocket in demand. But because it's long-term secular growth, i.e., we want to make sure we get new drugs to people who benefit from them to treat diseases, and people are getting older and they get chronic conditions. I mean, it's right in exactly the right space. But so once the backdrop, you know, frees up, these have got really good USPs. I mean, let's be clear about it. You can't just rock up and do a challenge trial anywhere in the world, because you've got to have licenses. It has to be highly regulated.
Yeah, no, that all makes complete sense. Although I would say, just to temper that a little bit, I think what's happened in the last 6 months or so with hVivo has really shown up that its business model is a lot more vulnerable than people thought. You know, this large lumpy contracts thing can just suddenly, so it means the profits are actually quite flaky and can just vanish if customers do cancel some big orders. So I think as a result of that, I would want to see it on a permanently lower valuation multiple maybe than what it had in the past. But no, I think you've pretty much talked me into buying some of these, Paul. I think I'll I'll buy a half position size in this, I think.
Okay, good. Well, thanks everyone for your questions. Apologies we haven't been able to get through all of them. Hold them. We're gonna our next discussion is at 2 o'clock next Wednesday, not Thursday. So if keep those, hold them over for then. I'd like to say obviously a big thanks to Paul for all his comments. We've gone through a shed load of really good stocks there, lots of ideas, and thanks again, Paul.
No, thank you, Paul. As always, brilliant hosting, and I love doing these. They're great fun.
Yeah. Well, look, we'll see you next week then, guys. Thanks very much.
Yeah. Thanks, everyone. Bye.